Captain Morgan, Jumbo, konnichiwa, ni hao. Hello, good morning. Jumbo, may your life be less horrible than it usually is. Yeah, Brooke, remind me in a bit. Happy to go through your trade plans. Yeah, what is the actual translation, Ryan, for Jumbo? It's something like that, right? Like, may your life not be as difficult as it usually is. I don't know. My Swahili no so good, huh? So anyways, let me remind you that trading risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. It is African, but although not South African. Yeah, I remember. Yeah, that's right. So Banks said it was, may your life not be as horrible as it usually is. Something like that. Yeah, cool. Yeah. KR is like, yo, wait, I have the hardest question to answer for the day. Okay. I don't know, Kenny. Google it. No, it has to do with the server. It's on server time. Anything else? Okay, so it's a Monday, right? So let's just go through some basics. We'll do commitment of traders report today. I don't know why, just because. And then, you know what? Then we'll go through the calendar. We'll go through some of your trade plans if you want, and so on and so forth. What do you stink? Smell like a plan? All right. How many people are new to the commitment of traders report? Anybody like just immediately say, WTF is this guy talking about? Nope. Cool. Still don't understand it. Well, that's fine too. Okay. How many people know what it is but has no idea what it means? Anybody? Yeah, I'm an expert. I don't know what it means, but I know everything else about it. Yeah. Cool. There's Rin. Love that name, Rin. Awesome name. I think my next kid's going to be named Rin. All right. All right. So, anyways, let's take a look at this. I think my resolution's off. What's going on? Maybe it's a Zoom issue. But $1.50. Look at that. Boom, boom, boom. Okay. Oops. And okay. I mean, is that it? Still doesn't seem like it's fitting properly. All right, so what you're looking at is the commitment of traders report. This is reported every Tuesday. Is that right? Every Tuesday at the close of trading to the Commodities Futures Trading Commission, otherwise known as the CFTC, which is a government agency. There's a reason for this. Years and years and years and years ago, back when I was knee-high to a grasshopper, the market used to go through booms and busts. I'm not talking about 2009. I'm talking like 2029 or 1929. But anyways, this, back in the day, the markets used to have these ginormous booms and busts. The government decided, you know what, this is just crushing our economy. We should probably keep tabs on what's going on. So at some point, the government gets involved, and it's really a clever little thing that is done now, so that we know how the market is structured, if you will. Okay. So what they did is they asked large institutional investors that have large institutional positions in the market, report those positions. How long are you in euro? How short are you in euro? It's all large institutional investors. Now, you might say, wait, not all large institutional investors are in the market for the same thing. And I say, that is true. So some are speculators, right? Like a hedge fund. But some are not in the market, right? Some are actually people that are hedging their risk. So, So what do we know? We know total volume, because, you can see how many contracts are out there. Then the government says, okay, if you're a large institutional investor, report those positions. So now you're like, okay, so now of the total, you see what the institutional investors are doing. And then to separate the bona fide hedgers from the speculators, the government says, well, look, if you're making and losing money on your hedges, we're not going to tax you on that, because that's not your business. If you're losing money on your futures contracts, you're locking in the price in the cash market, and that's sort of a wash. So the government says, look, if you're a bona fide hedger, let us know, and you won't have to pay taxes on it. So now which is a clever little solution, right? So now you can see the total volume of all trading in the market, the total volume of institutional investors, and then the total volume of institutional investors is separated from those that are speculators and those that are hedgers. Cool, right? So what else is there? What else can we learn from this type of data? Anybody? Bueller? 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 So what you do, well, long and short's reported, okay? But now you take total volume. Look at this. Guess I didn't put any, just didn't put any product in my hair this morning or something, huh? All right, so what you do is total volume minus institutional positions equals question mark. What would that be? Total volume minus institutional positions. Total volume minus smart money. Yeah, dumb money. Us. Non-reportable. No, not speculators, because you could have institutional investors that are speculators. Yeah, dumb money. Thank you. Cool, right? So now you got large institutional speculators, large institutional hedgers, right? Dumb money. Cool. So that's what this is all about. This is a large institutional non-hedging speculators. Let's just dumb it down and say this is what hedge fund managers are doing. They reported these positions on Tuesday to the government. The government compiled the data on Wednesday and Thursday and let's say part of Friday, and they release it Friday after close. So this data should be updated as of the 17th of November, which it is. Cool, right? So it's not new. I mean, this is a Tuesday. It's now Monday, right? But it's the most recent update that we possibly have. Okay. So let's take a look at this. You know, maybe I'll click in a little bit here. I do one. Yeah. Cool. All right. So the first thing we want to look at here. Well, how about let me identify things. Okay. What we're looking at here is the price of the Euro USD. Basically, a Euro USD weekly chart. Okay. Nice. That's just the Euro USD. Then switching over to a slightly different color. These are the positions. You add up the bulls, you subtract the bears, and that's the number of contracts open, net contracts. So what's left? Cool, right? Let's do, I'll do red and then I'll go back to blue. Okay, in light gray, you have the number of long positions. Guess I can't do that long in red, so let's do this. Okay, these are the number of contracts that are long. Week over week over week. Week over week over week. So what's been happening over the last few weeks? Last couple of weeks? An increase, a slight increase in the number of institutional investors that are long euro. What would have caused such a thing? We talked about it in great detail. Just want to see if you're paying attention. What is the fundamental reason for institutional investors to suddenly increase the number of positions? The commodity. I don't even know what that means, Kenny. The ECB cutting in half. Yes. The ECB is tapering their quantitative easing. Okay? That's all it is. Yeah, maybe investing and stuff out there, but let's just say when the central bank changes its policy, its monetary policy, it directly impacts the value of their currency. Okay? And I did talk about this in great detail. And I compared it to what happened when the Fed decided to taper. The US dollar got strong. Well, the ECB is now tapering its quantitative easing program, and the euro is strong. Why? That creates a floor to euro weakness. Okay? So there you go. So now a couple of weeks have gone by since that announcement. We could see immediately institutional investors are buying up euro futures. Cool, right? Okay, now in red, I'm going to do the short positions. I think I'm getting this right. Okay. Am I getting this right? No, it's here, isn't it? Yeah. Okay. Interesting, right? So check this out. Boop, 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 boop. Oh yeah, this is hard to see. Boop, 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 boop. Somewhere in here. Let me use an arrow. So it's straight. Somewhere in here. Okay. Don't look at this as an arrow. Just look at it as a horizontal line. At this point in time, okay, the market was bearish. This whole period here, the market is bearish. What this is that net line I showed you earlier. There are more bears than there are bulls. See the spread here? And then I guess it was more like this. Right in here is where there became more bulls than bears. And the net goes over the zero line. Isn't that interesting? So, is the institutional market long euro or short euro? Talk to me, Goose. Is that opinion? That's what you think? You know, I think hedge funds are long. I think hedge funds are long euro. I think they might be. They could be. I think they are. Yeah, I think they probably will be. My shoe shine boy. Right? So isn't it interesting to be able to talk factually? You know for a fact large institutional investors are net long, net meaning there are more bulls, right? There are more bulls than bears. The market is net long euro. And they have been since, I can't read that, May. Isn't that neat? And then, of course, the other thing you could look for is a change. Okay? Right? You can look at the change is what's even important, not the fact that it's net long or anything. But there isn't really a good example here. But okay, well, I guess I could do it this way. This darker blue line is the price. So generally in this period, price went up. Euro dollar went up. Okay? Let's see if this works out. Let's see if this cooperates. So generally speaking, the euro dollar went up. And this is the number of contracts going up. Is it flatter or steeper than the actual increase in price? This blue line are large institutional investors actually buying euro. I mean, they're buying euro, but it's not dramatic, right? So, what's the missing piece here? This is literally the number of contracts short. So they're looking over here. 25,000 contracts short, 17,500, or no, the other 175,000 contracts short, 100,000 contracts. So we went from 250,000 to 100,000 contracts short. It's literally less contracts short, less short. There are less bears. There used to be 250,000 bears in the market. Now there's only 100,000 bears. So less people shorting and some people buying, right? Significantly less people shorting, significantly less bears, and a few more bulls. The market is simply not shorting the heck out of euro anymore. And it hasn't, right? It hasn't been for a while. So 1 year ago, we were heavily short euro. We had this number, right? And now we're here, right? So there's 150,000 less bears. Pretty interesting, right? And how do you exit a bearish trade? You're short euro. Okay, you're short euro, so you're long dollar. What happens when you tell your broker to take profit? Your broker offsets you by entering a long position. Cool, right? So, really, I would say 2/3 of the euro dollar rally is simply institutional investors getting out of their short positions. They didn't necessarily buy euro, but they're certainly not thinking that we're on our way to 80 like they were before. Remember a year or two ago? Parity, parity, parity. You guys remember all that? Parity, parity, parity? And somebody asked me, I don't know, it was in an interview or something, somebody asked me, well, what about parity? I'm like, I don't give a damn about parity. Like, irrelevant. It's some magical price that's important to somebody. But only psychologically, right? So anyways, that's kind of interesting, right? Did that change? Let me just double check. Yeah. Cool. So the process in which you should go through this is, first thing you can do is look at the zero line. What does the zero line mean? It's neutral. The number of long contracts is the same as the number of short contracts. The market's flat. Okay. So you can see there was a time we were flat here. Well, actually, no, let me take that back because that's price. But anyways, first thing you can do is look at it and say, okay, so what it's measuring, guys, is this number here and this number here. Okay. The darker gray is long. The bluish one is short. So there are 50,000 contracts long, 125,000 contracts short. Okay, so what is the net? 125, well, I guess you got to do it the other way, right? 50 minus 125 is how much? Okay, it's not 75K. 50 minus 125 is minus 75,000, which is indicated right here. Okay. The number of long contracts, number of short contracts equals the net. Okay. So that's where we are now, not then. Okay. Interesting, right? So now that you know what all the lines mean and how you can interpret it. So back here, okay, you can see the numbers were quite flat, right? We were net zero. And look at this. Is there any meaningful difference right now? The number of long and the number of short. This is the zero line. So what we're looking at is this black line and how close it is to the zero line. What does that mean to you? Market's neutral. Should you be loading the boat on pound dollar? Is anybody surprised by that? You're like, really? But what? All I hear about on TV is Brexit, 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 Brexit. It's the end of the world. And yet you're like, whoa, I don't know. Institutional investors are really not that worried. No one is selling, but no one's buying either, right? Look at this, guys. Let me change the conversation a little bit. Right? It's kind of people just getting out of long and short positions. Right? It's not that it's braiding, it's that they're getting out. There's less bulls and less bears. That's meaningful, isn't it? Yeah. Well, it's not that it's stay away, but you probably have better things to worry about, right? These investors are just no longer exposed to that risk. Is anyone betting large on the pound? No. Or is anyone betting against the pound? Not meaningfully. Not as a market. Cool. Again, when you sit and talk to your investors, that might be interesting, right? What do you see here? This is Aussie. Okay. The number of net contracts, light blue. That's the number of short positions. And That's the number of long positions. So not a lot of change on the short side, but significantly less people buying Aussie dollar, right? Significantly less bulls. Not significant amounts of change in bearers, right? The market isn't heavily net short, but there's significantly, like 50% less long than they used to be back in September. Isn't that interesting? The market's not really shorting euro, but the market used to be buying, or sorry, not euro. The market's not necessarily selling off the Aussie dollar. It's simply getting out of long positions. Which means to me, maybe someday at the right time and at the right price, these bulls bet again. Ryan says this week, well, I know we're at support, okay? But there's a difference then, okay, put it this way for those that are still relatively new. Imagine the market for the Aussie dollar is just crashing. Aussie is just straight down. Is there a difference to find out that people are selling Aussie dollar versus cashing out of long positions? Just market sentiment wise, are people borrowing money to sell your Aussie dollar, or Aussie in this case, or they used to be long, maybe they're taking profit, maybe they're getting out of break even, or maybe they're getting stopped out for a loss. But is it important to you to know that the market isn't actively selling? They're just actively not buying. Kenny says there's a big difference. Cool, right? That's what this information is telling us. And this is available at Forex.Today anytime you want it. It's updated every Friday at the close of trading. Okay? They're large positions. They're institutional positions. They're updated weekly, but they're right here under news, COT report, commitment of traders. Okay? Remember, they're futures contracts, so they only represent the futures market, which means it's only in the United States. Okay? And they're in terms of dollars. So euro, dollar, pound, dollar, yen, dollar. Not dollar, yen dollar. Swiss dollar, Aussie dollar, Kiwi dollar, CAD dollar. Okay? Because there's future contracts. So if you're buying a Canadian dollars futures, you're paying for it in USD. You get it? Because you're buying a futures contract on Canadian dollar. So it's a little different than USD CAD, right? Or USD yen, it's the other way around, because you're buying a futures contract with your American dollars. Okay? Everybody good? Yee-hoo! Brooke. Okay. Brooke says, do it again. Right? In Chicago? Is it Chicago or New York that does currencies? I don't even know, actually. Somewhere there, somewhere in the world, somewhere in the United States, deep in a bunker beneath, I was going to say Chicago, but wait, they don't do it there, do they? New York, then? Where else would it be? Philadelphia? All right, so somewhere, probably New York, if not Chicago, if not that, I don't know. But somewhere in the United States, there's a trading floor. Or at least there used to be. Or at least there's like a museum with the trading floor. Okay? But this is where traders would buy and sell futures contracts. Okay? This is where a client says, let's take a typical, like, we'll do wheat, not currency, because, you know, different futures are traded different places, right? But let's say you're Nabisco, you make breakfast cereal, and you buy a lot of wheat, you buy a lot of corn. Why? Because you make cereal and probably sugar. All right, so sugar. Uh-oh. What's that all about? Okay, sugar, wheat, corn. Okay, let's talk about that. Those are ingredients you need every day to be in business because you make breakfast cereal. Great. You risk the price of your input, right? Your corn, your sugar, and your wheat. You risk that price goes up because you got to buy it. If price goes up 30%, are you going to stop making breakfast cereal? You're going to shut down the factories, lay off all your workers? No. All right. Is the price of your cereal? Do you want to increase it by 30% to cover your change in input prices? Sugar, wheat, corn go up by 30%. So at the grocery store, the box of cereal goes up 30%, right? Well, bad for customer, but what if your competitor, so let's say you're like, hey, look, what can I do? Price of corn, price of sugar, price of wheat went up 30%. What am I going to do, huh? I'm just a cereal guy. So you pass it on in cost, right? So you increase your cost by 30%. What if your competitor doesn't? They also have a sugary corn wheat type breakfast cereal, and their price stays the same, $1 a box. Yours went up 30%. And so there's someone at the grocery store, and they're like, gee whiz, these are kind of very similar. I normally buy this one, but it's significantly more money than this one. So all of a sudden, the consumer says, well, I'm going to buy this cheaper one. You see what I mean? And then you can slope and all that kind of stuff, and you can do all kinds of great microeconomic analysis to find out, price elasticity of these, competing products and stuff. But we don't need to get there. So it's important to the breakfast cereal guys that they need to keep their prices the same, right? Like you don't want a box of cereal going up 30%, down 20%, up 100%, down 80. You don't want and you don't, right? Maybe in South Africa, I don't know. But here you don't see volatility in prices of a box of cereal, right? So how do they do it? They lock in their prices. They lock in the price in the future, today. They do it today. They say, look, I need to buy some wheat 6 months from now. I'm worried the prices are going to go up. So I'm going to lock in today's price. So my future wheat will be at today's price. And if the price goes up further, it doesn't affect me whatsoever. I already got it. Okay? That's what a futures contract is, right? So in this case, somebody says, they're exposed to euro, or they're exposed to pound or something. In business, you can lock in today's price. So I'll give you an example. A friend of mine owns a protein business. He sells about $3 or $4 billion worth of chicken global every year. Okay? But he'll do a deal like this where a guy says, all right, send me some chicken, deliver it in 3 months. Okay? $50 million worth of chicken to be delivered in 3 months. But he has to buy the chicken, ship the chicken to his port, because he owns a port, right? Put it on a boat, ship it to the other country, put it into storage or whatever, right? And then redistribute it out and deliver it to the purchaser at the specified date, the specified amount, to collect his money, the specified money. That is not an easy thing to do, by the way, right? Right? That's not an easy thing to do. But he's putting up the money up front to collect on the delivery, so there's some risk. But also, what if the price of money changes? Yet alone chicken. Well, they already negotiated chicken, right? The guy's like, look, you deliver this amount of chicken to my warehouse on this date, I will give you $50 million. So they've negotiated the price, but what if the price of money, the value of money's changed? So now my friend, not only does he negotiate a $50 million deal, lock in the money he's going to collect 3 months from now, then he's got to go over and hedge. Because what if the euro drops 5% or the Polish zloty if it's going to Poland, right? What if the zloty changes 2, 3, 4%? That could happen in 3 months. On a $50 million deal, that's not chicken feed. That's protein, baby. That's a lot of money. And that's one deal. What if you lost 1 or 2 or 3% practically every deal you do? Well, you know, 3% of 6 billion is a lot of money every year. Yeah. You're like, dude, hundreds and hundreds of millions of dollars are missing. Oh, yeah. So, you know, he has to hedge, right? So in Switzerland, he has a whole team that simply hedges all the contracts. Currency prices. Polish zloty, 50 million US dollars converted into Polish zloty. Great. Hedge the zloty. That's what a futures market is, right? So if you're worried that the euro is going to go up, or if you're worried the euro is going to go down relative to the dollar, you use these futures markets. Okay? Now, a bona fide hedger isn't trying to make money, so that's why they separate them out. What we're looking at is what is the number of futures contracts, right? Because a futures contract, I don't know, let's just say it's $100,000 per contract, right? Kind of like you per lot, it's $100,000. Think of it that way, right? So how many lots is the market long? How many lots is the market short? What's the difference between the two? And you can figure out sentiment. Well, they're employees, Ryan. He does enough money in Switzerland where they're like, hey, do you want a citizenship? And he's like, okay, I guess so. Yeah. It's not a fund. It's his money. He must be loaded. Well, he sells billions of dollars per year in chicken. He's been doing it his whole life. This guy is, I don't know how old he is, honestly, but he's in his 70s. I'm almost certain he's in his 70s. He's not a young man, right? But he's cool, man. He goes Segway. He goes on Segway tours and stuff with college kids. Like, this guy is cool, man. Cool beans. Yeah, but so put it this way, Ryan. If you own a company that does $6 billion a year and you're poor, you're screwing something up. Like, oh my God, how am I going to get? I don't have change for the bus. Yeah. There is a guy named Davis Love III. He's a golfer, and his brother-in-law was his accountant. And one day Davis Love says, you know what, there's an audit, and they seem to have found an error, like, $5 million is missing from my money. Do you know anything about this? And he's like, no, that's weird. That's totally wrong. I'll look into it. He's like, okay, cool. I love you, man. Appreciate it. Next day, the guy kills himself. You're like, oh. So, yeah, kind of ruined. Yeah, his brother-in-law. Yeah, well, who was his accountant, who was ripping him off, and so it was kind of awkward at Thanksgiving. Yeah, you're like, that would, yeah, totally, right? And I think it was even more emotional than that thing about the story. I think the guy actually confessed. He's like, sorry, man, I've been stealing from you. I'm really sorry. Right? And I'm going to confess and all that kind of stuff. And so Davis Love, I think, forgives him. He's like, I forgive you. I understand. I love you. Don't worry about it. And then the guy kills himself. I don't know. It was bad. Bad times. All right, so let's move on. .com. Yeah, I mean, it's even worse when you think about it that way, right? You're like, oh my God. Yeah, happy thoughts, happy thoughts. All right, so here we are, Aussie. What are you going to do, huh? Nobody's short Aussie. Well, nobody in the United States, right? But I'll tell you what, we have this marked. Do you remember? It's not shocking. I mean, it's disappointing that we broke lower than this. That was the real disappointing. But this is that. I mean, this is that, and that's that. And that's it. That's it. That's all there is to that. Okay. Brian says we have to buy there if we're bulls. Yeah. Well, it kind of begs the question, why are you a bull? Right? So we'd have to debate this. Okay? Well, a bull is most successful in a market that looks like that. I think we can agree to that. And instead, it looks like this. There's even a dip in there, but whatever. It's not really the market we want. Yeah. So the best case scenario was like back when we were here in the beginning of October. Remember, September was awesome. Everything's golden. And then it bounced here, which was fine. It was all good. This was the real cluster. That's when it technically is bearish, right? As soon as it broke through here, retracement to the roll reversal and down. Son of a... So we may have to wait. Okay. Well, it's when do you turn off the spigot is all it is, right? When do you just, because, what I was saying before is you identify the next two levels in which you'll consider buying, right? That was also another one, but that's very less ideal. Because then at best case scenario, we work this range until it breaks out. But that didn't even hold. Right? So when do you cool the guns? You see what I mean? So I'm not saying you can't buy it here. What I'm saying is you should look for a reversal pattern. Is it going to go straight up? You know, I mean, that's the other thing. Like, so let's say it did this, and then it did this, and then it did this, and then it did this, and it did this, and then this, and then this. And now what is it going to do? This? Stranger things have happened, but I wouldn't assume so. So at very least, we could, you know, let it double bottom first, right? And then start some sort of trend. I mean, I don't know, right? We got to be smart about it, right? We got to be careful, I think, right? I mean, it was supposed to go up in so many other places, right? It was supposed to go up here. This was great. This was a lot less ideal. This was like our last line of defense. And now what? We lost the Alamo, man. Right? Right? You're like Davy Crockett and you're surrounded by a bunch of guys that speak Spanish. And you're like, I think we might have lost this one. Right? Right? Like, this doesn't feel good. No, senor. Yeah. So I don't know, like gold. Dang it. September was beautiful. Yeah. So I don't know. I'm just telling you to be cautious, right? There's nothing wrong with that. I'm not talking to myself. Oh, what the heck is this? Hang on. And nobody's home. Huh. Well, it might be a great day. All right. Well, it's just like, look, let me uncomplicate things. Okay, that's what I was kind of trying to do, but let's do it again just to make sure. If you're a bull, okay, which is fine, don't you need to make sure market conditions are favorable to your trading? Right? If you're a bull, you simply say, hey, is the market bullish or bearish too? If the market is bullish too, you're bullish and aggressive. If you're bullish and the market is not bullish, you can still be bullish, but you should be conservatively bullish. So at the very, 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 very least, you need more before you pull the trigger. Okay? You're not eager, right? You're not Maverick, you're Iceman. Okay? Yeah, well, whatever that means to you. But yeah, like, wouldn't a double bottom, higher high, higher low scenario be like the minimum requirement sort of thing? What if you just sat on this until you saw something like this? Okay. And of course, along with that, you're likely, I mean, it doesn't have to be, but I couldn't imagine a world in which suddenly Aussie dollar started going up, but you didn't hear a change in tone at the Reserve Bank of Australia. You didn't see improving import-export data. You wouldn't see an improving commodities. I mean, commodities are down, right? So I would have to imagine that all that other fundamental data is also improving, whilst you have a change in direction in technicals. And then maybe that's when you guns are blazing, right? Now you're Billy the Kid. Fire, fire, fire. Aussie, Aussie, Aussie. Oi, oi, oi. Right? But make sure it's not a blaze of glory. You don't want to do a Thelma and Louise with your account, right? I know. I mixed up, how dare I too, right? Did this guy just mix up Young Guns with Thelma and Louise? Oh my God. I'm sorry, man. Sorry. I love Emilio Estevez. How dare you? Yeah, all right. All right. How are we doing on oil? This line here was a plausible sell zone. Well, you have to trust me since I can't grab it. Been talking to myself and nobody's home. Okay? Cool, right? So if you're a bear, that's that. And if you're a bull, that's that. Which one's going to be right? I have no idea. But I believe our conversation at some point was if you're a bull, you buy it off the 21, and if you're a bear, you sell the retracement, right? Can't be sure. But both of those are factual, is what I can tell you. If you're a bull, buying at the 21 is like the most basic strategy there is. And then on a smaller time frame, especially, right, a 1, 2, 3, 50% roll reversal, pivot type thing. If you're a bear, that's irresistible, right? And of course, this is also very bearish up in here. I had one of those days where I made breakfast and I haven't eaten it. Been up too long. I'm old, but I'm not that bold. So I might have to pull the trigger, although it's at 8:39, so I guess it's about right, time-wise. Might have to jump, babe. I'm getting pretty hungry. Talking to yourself. Yeah, I think I'll go eat. I hope you noticed that all the videos from last week are on YouTube and on Forex.Today. Have you guys subscribed to the YouTube? Forex.Today YouTube so that you're updated when I do that. Cool. Appreciate you. It's a short week in the United States of America. I will do a webinar on Tuesday. I will do a webinar on Wednesday. And then I'm going to go to the beach. However, I might also go to Hong Kong or Singapore. I don't know. I might go today. I still don't know. But I also might go to Dubai, and maybe today, but I don't know. So I'll either go to Florida on Wednesday after the webinar, or I'll go to Hong Kong or Singapore or Dubai, or maybe all four, but I don't know. But I'm hoping to go to Florida for sure. But that might be canceled, so I can do the other thing. But, so what I'm thinking, Daniel, if I had your way, I think I should go to Singapore. Cool. No, Kenyon has been bugging me. I like to plan these things, but I'm living a complicated life. And so, these are complicated things I'm working on, and all of a sudden things happen, and it's usually me doing it to myself. I'm the type of person, and I've done this multiple times now, where I say, I only do business with people I've met and that I know. So I'm going to get on a plane and come have lunch with you or dinner or whatever it is and fly to the other side of the world. That moment, like, I'm going to get on a plane now, I'll see you tomorrow, click, and all of a sudden, next day I'm in Abu Dhabi having lunch. So it's one of those things where if there's business, I do it to myself, right? So I'm just going to get on a plane and go. And if it doesn't happen, then don't worry about it. Right? So that's where it is. Yeah. That's the right way to do things, I think. I don't know. Those things usually burn me. Do things the way they're supposed to be done. I don't think the world gives a damn about it, but I guess I'm old school. I'm bold, but I'm not that old. So anyways, peace on earth. May the pips be with you. May your profits be above average. So yeah, I think most likely I'll be here all the way to Wednesday. We'll do Wednesday's webinar, and then I'll take off Thursday and Friday, no webinars, because it's Thanksgiving in the United States and you don't want to trade those days. Markets are closed on Thursday. They're probably open half the day except for bond markets and banks, and it's weird, but you don't want to be around that day either. So I'll probably see you tomorrow. Probably. Maybe. Most likely. Probably. Get that man some gel. Cheers.